I'm Dani Francini, and today's topic is asset allocation. Time is the only cure to market downturns. We've basically seen a stock market crash about every 7 years throughout your lifetime, and time systematically heals each of those crashes. Let's understand this from a historical perspective. There have been a few 5-year crashes in your lifetime. There's been one 6-year crash in your lifetime. There's never been a 7-year crash in your lifetime. Now, that's not to guarantee that there won't be a ton of 7-year crashes in retirement, but we have to use time as our perspective. Let me give you a sentence, and then you think about it. You're going to retire somewhere around age 60, and you're going to be retired for a little over 30 years. Over those 30 years, we expect to encounter multiple stock market crashes, but we're certain that if we give each crash enough time, it will always result in a new all-time high. When you own a well-diversified equity portfolio, what you actually own is 500 to 1,000 of the best-run companies in the history of the world. By owning them in mutual funds, you're also keeping yourself diversified from the business risk of owning a company like Apple or Microsoft. Even if Apple is your largest holding, maybe it's only 3% of your whole portfolio. But one thing you can't diversify away from is market risk. When the market crashes, everything crashes. The cause of each one may be different, but once it starts, everything is going to go down. The only way to recover from that crash is to be patient and do nothing. Let's just wait and sit them out. The worst thing you could possibly do would be to panic and sell your investments. When you had a 6-figure paycheck coming in, it was easy for you not to panic when we went through the downturns of 2001 and 2002, or 2008 and 2009, or during the small COVID collapse. But when you're relying on your nest egg for your 6-figure paycheck when the crash of 2032 happens, that's when you absolutely cannot sell. We need to give the market time to rebound. The second thing that happens by sitting tight and not selling is now you're allowing your fund managers to take advantage of what the public panic is offering. In 2001, when the tech bubble burst, our fund managers bought tech stocks at a discount in fall of 2002. In 2008, when we had the financial crash, our managers bought banks and insurance companies in the spring of 2009. By you not selling, you get to take advantage of having a relationship with professional money managers that know which depressed stocks to buy post-crash when they're all on sale. We find that some of the best returns are made coming off of an all-time low in the market. So when you let time heal any market crash, what you're doing by not doing anything is allowing your money managers to take advantage of what the public handed them. We saw it with tech in 2002, financial stocks in 2009, and even during the COVID collapse when we suddenly owned more of the companies that were thriving in a new virtual environment. But if you sold, you missed those opportunities. Thank you for listening, and I hope you found this helpful.